ECN listeners, this is your weekly FX update brought to you by Rare ECN. This week commentary will largely encompass the euro-dollar market. An oversaw euro with continued weakness expectation on the back of a divergence in the eurozone and US fundamental and monetary policies. Technical bearing on the euro-dollar market indicated a bearish and oversold price action as the pair is subjected to this week's risk event, spanning to include the German IFO print to eurozone CPI number and US GDP report. This commentary will be broken into two components. Firstly, we will explore the euro-dollar market on the technical aspect. Without a doubt, last week's poor performance in the euro-dollar market have left the single currency at an 11-month low. Currently, the pair is trading between the 61.8% expansion at 1.32004 and the 76.4% expansion at the 1.31507. And according to the SSI, which is commonly known as the Speculative Sentiment Index, retail FX traders continue to long the euro, with contrarian trading leave us in favor of further weakness. Currently, long euro-US dollar interest is sitting at a ratio of 2-to-1 against short interest. However, despite analysts calling for a continued weakness in the single currency, the pace of this decline is most likely to slow. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar cross is suggestive of a temporary bearish market sentiment and recommend long position on the greenback. The euro-dollar cross opened today's Sydney trading session inching closer to the established Fibonacci resistance at 1.3205, while the Fibonacci support is set up at 1.3183. Since last week's euro-dollar correction to the downside, the pair haven't managed to break above the 200-day simple moving average during the end of last week's trading session. Therefore, this is very indicative of a long-term bearish outlook on the cross moving forward if it cannot hold above the 200 days. This bearish standpoint is also validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5, 10, 20, and 30-day simple moving average, which is indicative of a sell recommendation on the moving average front. Moving along to the fundamental components of the euro-dollar market, the euro-dollar pair had an extraordinary decline for a large part of last week's trading session. Some aspect of this decline can be attributed to a weaker than expected eurozone fundamentals. For instance, last Thursday, the French manufacturing PMI continued to contract by coming in below expectation of 47.8 at 46.5. In addition to that, the eurozone manufacturing PMI also fell below expectation at 50.8 when forecasts expected 51.3. However, a slight growth in German manufacturing PMI failed to trigger any significant turnaround in the price action of the euro-dollar pair. German manufacturing PMI grew at 52.0 when forecasts expected 51.8 reading. Nevertheless, at the end of Thursday trading session, the extreme bearish sentiment on the single currency broke and short-term reversal took place on the back of investors' profit-taking on the greenback. This has allowed the pair to retrace initial Thursday decline. However, this rally was short-lived as testimony from Draghi and Janet Yellen triggered the last leg of decline for the week. Draghi Friday testimony is a mere reminder that the structural fundamentals and monetary policy between the euro and the greenback are diverging. The announcements of the next wave for QE program by Draghi back in June is ready to roll out in the near future. However, the bank is concerned that the effectiveness of QE program to stimulate consumption may dampen over time. Draghi also commented on the formula to lowering eurozone unemployment rate is striking a balance between monetary policy, fiscal as well as structural reform. Unlike the US, this week eurozone leading economic indicator is expected to deteriorate. Opening this week trading session is Monday's German IFO Business Climate Index expected to roll in at 107, while the German business expectation is forecast to read at 60.2. On Thursday, the German unemployment chain is expected to show a 5,000 unemployment claim contraction, while the unemployment rate is expected to stay in at 6.7%. Meanwhile, German CPI month-on-month print is forecast to expand by 0.2%. Wrapping up this week trading session is Friday. German retail sale month-on-month forecast to come in at 0.1%, while Eurozone core CPI year-on-year print is expected to read at 0.8%. Eurozone CPI year-on-year is forecast to sluggishly expand by 0.3%, while the unemployment rate is expected to remain at 11.5%. It is the fall in inflation expectation that act as a gauge for Draghi to implement aggressive stimulus package. So without a doubt, last week technical and fundamental bias support the greenback. Take last Thursday U.S. home report, for example. U.S. existing home sale grew to 5.15 million, beating forecasts of a 5.02 million, while month-on-month print showed 2.4% expansion, beating a 0.4% contraction forecast. The Philadelphia Fed Manufacturing Index also grew to 28, beating expectation of a 19.2 reading by a significant margin. The greenback rallied against the single currency on Friday on Janet Yellen's speech at Jackson Hole. Investors are expecting Yellen to change her rhetoric from last week's FOMC minutes and give the market reason to price an earlier rate hike. However, the Fed continued to remain firm on its status quo. Thursday greenback profit-taking was the market's way of bracing for a dovish rhetoric from the Fed, and since Yellen is one of the most conservative member of the FOMC, the market expected her to downplay the consistent improvement in the U.S. leading economic indicators. However, status quo approach and lack of strong dovish rhetoric has given investors reason to power back onto the greenback. This week is packed for a market-moving rest event out from the U.S. The Eurozone peer will open this week's trading session with Monday U.S. new home sale print forecast to add 430,000 sales, while Tuesday the U.S. will release its core durable goods order month-on-month print, expected to read at 0.6%. Also, the U.S. CB consumer confidence is expected to come in at 89. On Thursday, the highly anticipated U.S. GDP quarter-on-quarter print is forecast to grow by 4%, while the GDP price index component is expected to read at 2%. Meanwhile, U.S. initial jobless claim is forecast to come in at 300,000, while the U.S. pending home sale month-on-month print is expected to grow by 0.6%. Wrapping up this week's trading session is Friday. U.S. personal spending month-on-month is expected to grow by 0.2%, while the Michigan consumer sentiment is forecast to come in at 80.2. I want to thank all our listeners for spending our time with us, and have a successful trading session, everybody.